On December 1st of 2017, your company pays an annual insurance premium of $3,600 that covers December 1st through November 30th of next year. Show that's 12 months over, okay? Show that the adjusting entry on December 31st of 2017, if $3,600 payment was recorded in prepaid insurance. Okay. So on December 1st of December 1st, the journal entry is prepaid insurance $3,600 debit. That's an asset. That makes sense. And cash goes out of your pocket. That's a credit, far away. Cash goes far away. So that goes out of your account. So cash goes down as an asset, and prepaid insurance goes up as an asset. So you give up one form of asset and you get another form of asset. But $3,600 divided by 12, that's $300, right? So just for month of December, you need to recognize $300 of insurance expense. Remember, whatever happens in 2017 stays in 2017. So you have to recognize that. So recognition of insurance expense, debit to increase the expense. And then the asset that you have now goes lower by $300. That's a credit. So asset will go down, expense goes up. Show the adjusting entry on December 31st if $3,600 payment was recorded in insurance expense. So this is one type of bookkeeper who wants to do bookkeeping this way, which is fine. But there is maybe another bookkeeper who likes to do bookkeeping this way, which is saying, okay, debit insurance expense, $3,600, and credit cash. So debit insurance expense, credit cash. So let me maybe create some space here. Yeah. So on December 31st, this bookkeeper, on December 1st, this bookkeeper recorded insurance expense debit. So he recognized all of it as an expense. That's fine. We are doing still accrual basis of accounting. So still this is okay as long as we do adjustments, right? And cash goes out of pocket. Correct. So in this way, expense is way too much, right? But we are doing accrual method. And under accrual method, you have to make sure that you don't recognize too much expense, right? So, you know, your expense should be only $300. So you have to reduce this expense in the T account by $300, by $3,300 to leave it $300 on it. So I like to, again, I told you to do this. Hopefully you remember, I said every time I show you a journal entry, you have to have a blank paper next to you and post this. Just to emphasize this one more time, I'm going to do this myself, but I want you to do it, okay? Not me. Okay, here is my paper that I have next to me. Here we go. So in this second method, the bookkeeper puts, you see, that's the cash they have. And bookkeeper paid $3,600 to get insurance policy, and he recognized it as expense right away, which is fine. But at the end of the month, first month, it's December 31st. They have to recognize whatever happens in 2017. So we said, okay, expense is too much. It should be only $300 of expense because 3,600 divided by 12 is $300 a month insurance policy. So should be only $300 expense, but we have here 36. How do we make this to become this? In order to make this to become 300, we're gonna deduct $3,300 from the expense. That's a credit, and we put it a debit here, and we call it prepaid insurance. So this way, you can see in your T account that what's going on exactly. So now you see that your insurance expense has only $300 of balance, and that's correct. So check. I like that, right? And how much asset you should have? 3,300. That's check. That's also good. That's what I like. So as a bookkeeper, you have to make sure that you have correct amounts in your T account at the end of each accounting cycle. The first method was same thing, literally. As I said, whenever I show you the journal entry, make sure you have this notebook next to you and immediately post it to the T account. So here we have some cash, and then we spent $3,600, but this bookkeeper wants to put it in the prepaid insurance. Either way is fine, doesn't matter, as long as you're doing adjusting entry anyway. So based on accrual basis, that prepaid insurance needs to be adjusted at the end of the year. So we know that 1 month is $300 of insurance policy. So we're gonna reduce this prepaid insurance by $300. That's a credit, and put it debit here. We call it insurance expense. So the prepaid insurance ends up to be $3,600 on the debit side, less $300 on the credit side. The answer is on the debit side, which is $3,300. And this number is exactly matching that number. And this number is exactly matching that number. So either bookkeeper is doing a good job, there's no problem. It's just option 1 or option 2. It's your choice, whichever you want to do it. You need to be just smart enough to understand that every single account that needs an adjustment should be adjusted at the end of the accounting cycle. Questions, please?
Yes, I do have a question. On the bottom, the prepaid insurance in the middle, the 3,600 and the 300, those are on different lines, right? Am I correct?
Yeah, this is debit.
No, I know they're in different columns, but are they on the same line?
Yeah, doesn't matter.
It doesn't matter?
Doesn't matter, no. Remember, this is a classroom type of T account.
Okay.
Make sense? This is something that if we are talking about something and we want to just have a picture, we just draw a T account and put the numbers there, so we get the idea. Make sense? But a smart T account looks totally different. Smart T account doesn't look like that. A smart T account looks like something like this. Probably something like this. Name, debit, credit, balance, debit, credit. So draw this, that. This is a smart T account. So you're gonna, a smart T account says, let's do the adjusting entry. No, the first, like this one that we did in here. Let's show you the prepaid insurance here. So imagine this name of the account is prepaid insurance. Okay, so this is the account name. Account number is, let's say, prepaid insurance starts with 1. It's an asset. Let's say 135, for example. So that's account number. That's the name. The date, it says no, December 1st, 2017. That's the date. And then you call it, let's say, insurance policy. So we have an insurance policy that we explain it like that. And we put in this account prepaid insurance with account number 134, we put $3,600 as a debit. Okay, so that means the balance is $3,600. So how much do we have in the balance of this T account? $3,600. Make sense? So let me double line this so you understand that this is the balance area. Okay, so that's a dollar sign. How much do we have? $3,600. And then here we did a credit of $300. So the date is 12/31/2017. Adjusting. So this is an adjusting for end of the year. And here we have a credit of $300, right? And the balance now is 36 less 300 is 3,300. So now the balance is 3,300. So this is a smart T account.
Okay. Right? Okay, it makes sense now.
Yeah. So bottom line, in the middle of a classroom problem, I'm not gonna draw a big smart T account like that. You're gonna do this in Excel.
Yeah.
In Excel project, you're gonna do this. You're gonna have a T account like this for every single account, and you're gonna have account name at the top, account number here, and every single journal entry needs a line. It has a date. It has maybe a description and a debit at that moment, and then final result. Another date, description, a debit or credit, and then final result in the balance. So the balance is constantly updated. And in the Excel, you say, okay, this box in the Excel equals to that box. That box in the Excel equals to, you say equals to that box at the top plus this minus this, enter. And,
okay.
And then in Excel, you grab this small fill handle with your mouse right there, and you drag it all the way down. You drag it down, and then every balance after that you put in here, it will get automatically updated by itself.
Okay.
But instead of doing all this, here in a classroom, we like that. The T account, simple, debit, credit, same thing. In a real life even, if you want to kind of see in a real life what I'm doing exactly, you can just take a paper, put those T account, put the numbers inside, just make sure it looks good to you, you understand that, and you then go ahead and do the journal entry. And turn off the camera. That's the number 2. Okay, Jilko pays $900 for office supplies. As you read this, you have to put it in the T account, okay? So have your paper ready, put it in the T account. In April, and debits office supplies. Okay, so it says paid. That means cash goes out. So debit office supplies, $900, credit cash. On May 31st, Jilko's year end, a physical count shows $200 supplies left. Okay, so now you are looking at the T account. and you see, okay, the T account shows $900 in office supplies, but the physical count at the end of the year shows only $200 left. So how do you get from 900 to 200? And that's where you say 900 minus 200, that's 700. So that's $700 of supplies that has been used. So in that case, supply expense will be debit and supplies will be credited. If you don't do this, what would happen? Obviously, if you don't recognize expense, expense will be understated. And if expense is understated, that means net income will be overstated. If net income is overstated, then retained earning in the balance sheet will be also overstated. And if you don't reduce the asset here, then asset will be supplies, asset will be overstated also. And if asset is overstated in your balance sheet, on the left side, asset will be overstated. On the right side, the retained earning will be overstated, which again, you don't like that. I remember I had a formula before I was using, I wonder, yeah, that formula, see that? If I copy that, I can put it right here. So you kind of see the same thing. So in the income statement, if you don't recognize this expense, the income will be overstated. So the income will be overstated. And in the balance sheet, if you don't reduce these supplies, supplies will be over. That means asset will be overstated. And liability has nothing to do in this case. But equity, because net income is overstated, then retained earning in the equity will be also overstated. So asset is overstated, equity is overstated, balance sheet is balanced, but the numbers are wrong. And your financial statement is also showing too much profit, which is fraudulent financial statement. It doesn't show the reality. Okay. So if I want to show you the T account, I hope you did it. That was my concern. Hopefully you do it every time. Otherwise, it's hard to understand. But let's say I want to show you again. Here is the T account that we purchased $700, $900 of supplies, and $700, $200 is left. Okay, so this is the cash T account. We have some cash. We paid $900 and we bought supplies for $900. And then at the end of the year, we did the physical count and we see it should be $200 left at the end. Okay, so the question is, how do I make this 900 to become 200? So 900 minus 200 is 700. So I'm going to take $700 on the other side and put that as a debit here and call it supplies expense. So here is the supply expense, $700, and credit supplies. So 900 less 700, it becomes 200. Check. That's what I like. And supply expense is showing. The following table shows insurance premium paid by 3 unrelated companies. So here is the base. Remember, I said use base, beginning, added, available, subtract, and VAASE. So here is the beginning, added, beginning plus added is available. available minus subtracted gives you end. So I'm gonna take this number and show you the example so you can see. It is 500 beginning, 4,000 added, and used up during the year is 3,000. Ending balance for prepaid insurance, how much is it? So let me show you the account. I mean the base that I was referring to. So here is the base. This method will be used a lot in accounting, so get used to it. We call it BAASE, beginning, added, available, subtract, end. You don't need to write it, but I'm gonna write it here so you see. Beginning, added, available, subtract, end. BAASE. So the beginning for this example was, I have to look at the Word document. Give me a second. The beginning was $500. We added another 4,000. So the available is 4,500. And it says insurance used up during the year is 3,000. So that's subtracted. So question is, what is end? So that is the missing part. So let me look at my video now. There you go. So beginning, added, available, subtract, end. So by just plugging in those numbers in this BAASE format, so beginning added is available 45, 3,000 is used, subtracted. So what is the end? 45 minus 3 is 1,500. That's it, simple like that. And we're gonna use this base for so many reasons. So just get used to it. It's gonna help you in a exam, multiple choice, in a certification type of test. You don't need to write beginning, added, available. You just write BAASE, plug in the numbers, get the right answer, move on to the next question. Make sense? So the efficiency of how you take an exam is important. Questions? No? So here is dollar, but imagine it can be anything. Make sense? This can be anything. It can be units, it can be dollar, it can be anything, doesn't matter. All I'm gonna do is just using this BAASE to see which part is missing so I can figure out that part. Okay, so here is the answers already for you. Here is the solution. Just try to do the same BAASE format and see if your answers are matching with my answers in here. And here says, if ignoring dollar amounts, give all the possible journal entries to record the premium payments. So if you pay for premium, there is one option that you record the payment as a prepaid insurance or prepaid whatever, prepaid rent, prepaid insurance, and then cash will be credited. That's one option, right? The option two is when you record everything as expense instead of prepaid insurance, you call it insurance expense, and then cash is credited. In either way, cash is credited, but the question is, do you like to record all of it as an asset and then adjust, or record all of it as an expense and then adjust? Either way, you have to adjust no matter what. Okay. There's no question. I'm going to move on to number 4. On September 1st, Barco signs a 2-year rental agreement for a total of $6,000 which it pays in advance. So cash is credited, right? And something is debited. Now, something is debited depends what type of, which way you like to do it. If the prepayment was booked as prepaid rent, what is the year-end adjustment? So if you record the prepaid rent as a debit, $6,000, so put it in the T account, please, cash credit, and prepaid rent debit, 6,000. And that's on September, and that's 2 years rental. So September, October, November, December, that's 4 months. So 6,000 divided by 24 months times 4 months, that's $1,000 of rent expense to be recognized, right? So you're gonna do, in that case, because you have no rent expense yet recognized, you're gonna record it $1,000 of rent expense and take it out of that prepaid rent asset. So if you update your T account, you will see that your prepaid rent right now has $5,000 balance, and your rent expense T account shows $1,000 balance. The option 2, do it this way. If prepayment was booked as rent expense, what is the year-end adjustment? So in option 2, draw a line, create another T account. Cash will be credited no matter what for $6,000, but the debit will be rent expense, $6,000. So $6,000 rent expense in scenario B, that's what we have. Now, at the end of the year, we know that rent expense should be only $1,000. That means you have to reduce your rent expense T account to make it $1,000 balance. So you have $6,000 already, but you want $1,000. So that way, your prepaid rent needs to be updated to show $5,000 of asset, and you take that from rent expense T account as a form of credit. So prepaid rent debit, 5,000, and rent expense credit, 5,000. Now, if you look at your T accounts, you will see both scenarios. They show rent expense of only $1,000 at the end of the year. Any question, please? One more time. Every time we do anything in here, you update your T accounts on your note paper, just to see the whole thing. Never, ever do anything without T account. Any question on number 4? Okay. In number 5, number 5 says, in August, Gemco, which has an October 31st year end, so be careful on that, pays $1,200 for office supplies. August, September, October, 3 months, okay. And records it in supply expense. So you put $1,200 immediately in office supply expense, T account. On October 31st, a physical count reveals $440 of supplies unused. So we should have a supply T account showing $440. So we're gonna take that $440 from the expense account and put it as asset account. So asset supplies will increase by $440, that's a debit, and expense will be credited by $440. So how much expense now we have? $1,200 less $440. How much expense do you have? $1,200 minus $440. That's $760. That's what expense you have left. Make sense? So $760 of supply expense you have to have left in your T account. How much supplies do you have as a form of asset? $440. So you are adjusting your expense. If you don't do this adjusting, what's going to happen? So if you don't increase your asset will be understated in your balance sheet. If you don't reduce your expense, then your expense will be overstated. If the expense is overstated, that means income will be understated. If income is understated, that means retained earning in the balance sheet will be understated. So if I copy the same thing I used before, so if expense is not reduced, the expense will be overstated. That means net income will be understated. If supplies is not recognized, then asset will be understated. Has nothing to do with liability. And equity will be understated, because if net income is understated, that means retained earning in the equity will be understated in this corporation. So this is the scenario that will happen. So the formula is still balanced, because understate on the left side, understate on the right side. It's equal, but it's not correct. Net income is also messed up because it's understated on the net income. Questions, please? Okay. Let's go to number 6. Okay. For number 6, I'm gonna have a little bit of lecture here for you. So this is the things that I made it to make it organized. So let's learn this. Take a picture, write it down. Let's discuss this part. It's a little bit complicated, so let's look at it carefully. We have 2 types of write-off for accounts receivable. You know, when you have accounts receivable, you are very happy, right? You did the job, you send an invoice, and then no check is coming in. Week after week after week, no check is coming in. You call them, you try to, ask nicely, ask by respectful manner, but they are not paying. Some of them go bankrupt, that's why they are not paying. Some of them just disappear, they are not paying. So when you have accounts receivable, doesn't mean that accounts receivable will be collected 100%. It means a portion of that accounts receivable most of the times will not be collected. Your job is to recognize what percentage of that accounts receivable will not be actually collected. And you don't know honestly exactly, but you can estimate. And that's all we want as investors, creditors, stakeholders. We want you as an accountant to be honest with us. So your job is to be honest and stay honest and give us as much as information that we need in an accurate format. So you have to estimate that what portion of your accounts receivable will not be collected. The direct write-off method is not doing that. Direct write-off method says, I'm not gonna estimate what will not be collected. I'm gonna wait till when it happens, then I will write it off. And GAAP doesn't like that. GAAP says that's not good picture for us. We don't want that. Then who's gonna use direct write-off? Maybe in a tax purposes, you can use it as a direct write-off. But under GAAP, that's not acceptable. To wait till 6 months later in the middle of a summer, say, oh, the accounts receivable that I show revenue last year, now it's not collectible. I'm gonna write it off. The company went bankrupt or whatever. That's too late. So direct write-off is not acceptable. What is acceptable for GAAP? Allowance method. Allowance method is acceptable. Okay. Now, here is where I organized it, okay? You don't see this organization that the way I do in any book. So I just organized it for you so you can easily learn and easily remember it. Okay. Allowance method, I have two options. Either option is fine for GAAP. Either option, fine. Option one, percentage of credit sales method. Percentage of credit sales method, that means you go with the percentage of the whole credit sales for the whole year. And what is credit sales? Credit sales means you recognize the sales revenue by sending an invoice. Obviously, if you charge credit card and record a sale, or you receive cash, record a sale, that's not credit sales. So you separate all your credit sales as a form of sales that you finish the job and you send an invoice and you wait for a check. That's a credit sales. So the balance in the allowance for doubtful account or allowance for uncollectible account, either way you can call it, is not important for the calculation of proper adjusting entry for bad debt expense. So you're gonna have an allowance T account, allowance for doubtful account, or so-called allowance for uncollectible account. And the balance left over at the end of December 31st in that allowance T account is not important for the calculation of adjusting entry. Got it? Is not important. Is not important. Now, in method number 2, which is receivable method, because you are focusing on the very small amount in the accounts receivable, instead of focusing on the big credit sales of the whole year. Let's say the credit sales of the whole year is just $1 million, but the receivable at the end of December 31st is 100,000. So you are focusing on the very small amount of 100,000 in the accounts receivable. And because of that focused concentration in the accounts receivable itself, the balance in the allowance T account is very important for the calculation of adjusting entry for bad debt expense. Got it? Now, assuming you are using this receivable method, you have two options, option A, option B. For option A, you're gonna use just the T account of accounts receivable itself and estimate a percentage that will not be collected. That's good, right? Or you want to be more picky and specific. If you like to be more picky and specific, then go with option B. In option B, you go with the percentage of aging accounts receivable. That means you say, I have few customers with this much balance, they are 30 days late. I have few customers with that much balance, they are 60 days late. The other group, 90 days late. The other group, 120 plus days late. And because of categorizing all your clients in a specific late segment, you put a higher percentage of not being collected. So clients who are 30 days late, they will be maybe, for example, just 5% chance not be collected. But client who are 60 days late, the collection chance goes barely to 70% chance. 30% chance not be collected. If it's 90 days, you estimate 60% chance not to be collected. So the chance of not collecting goes higher as it become older, past due client. Make sense? Any question up to here, anyone, before we go for a problem to look at it? Okay, bottom line, make sure you just take a picture of this, write it down. This is the cleanest, organized way to put all this information in one page. Now you're gonna see the problems down the road, but constantly make sure you understand that how many ways we can do write-off. Allowance method is acceptable for GAAP. We have option 1 and option 2. Option 1, percentage of credit sales. Option 2, percentage of receivable. If you like to go with option 2, then option 2, you have two options, A and B. A, percentage of accounts receivable itself, or percentage of aging accounts receivable. Aging accounts receivable is much more precise, but it takes a little bit more time because you have to have a little bit more collection of data. Percentage of accounts receivable will be a little bit easier. Okay, let's go. So GOCO purchased a building for $350,000. If the building has an estimated life of 30 years and the residual value of $50,000, what is the adjusting entry in the year of purchase? So this is easy. You're gonna say, how do I calculate the depreciation for annual basis? So in order to do depreciation in annual basis, you write first the total cost. Total cost is the cost of the item you purchased plus registration escrow fees, title fees, title insurance fees, deliveries, shipping for the delivery, and testing. Let's say you buy equipment. In this case, it's a building. So total cost of building plus escrow fees. And then you have to estimate a residual value. You might say 0, you might say 50,000, whatever. So total cost minus residual value gives you depreciable amount. Total cost minus residual value gives you depreciable amount. Depreciable amount divided by estimated useful life gives you annual depreciation. So 350 original cost minus 50 residual value or salvage value, which you believe you might be able to sell it at the end of 30 years. That gives you 300,000 depreciable amount. 300,000 depreciable amount divided by 30 years, that will be $10,000 a year. Then you recognize the depreciation expense for that building or equipment, whatever it is, and you recognize accumulated depreciation. Accumulated depreciation dash building is a contra account to the building T account. So let me put this in a paper just so you see. So you buy, let's say cash. You buy a building for $350,000, cash is credit, and you capitalize the building asset. And that's what you do. Capitalize, that means you don't recognize expense. and you capitalize this purchase of the asset as a fixed asset that you're going to use for many years, and you're going to depreciate it on an annual basis. We have two types of ways that you can spend money, either revenue expenditure or capital expenditure. Revenue expenditure means you spend, let's say, $300 for utility, and you call it utility expense. That's a revenue expenditure. But if you spend $350,000 for a building, which you're going to use for many years, you're not going to record it as revenue expenditure. You're going to record it as capital expenditure. So you capitalize the asset right now, and then you depreciate it as a form of accumulated depreciation dash building. Okay, so you're going to depreciate it in a T account, which is contra account. So this account is a contra account to main account. So in accumulated depreciation, because the main account is an asset, is a debit, accumulated depreciation will be on the credit side. So how much is it on an annual basis? So here is the calculation. For cost, total cost, minus salvage value or so-called residual value divided by useful life. Total cost minus salvage, estimated salvage value, it might be zero, it might be whatever. In this case, 350K minus 50K, that gives you the depreciable amount. Depreciable amount divided by useful life of, let's say, 30 years. So depreciable amount divided by useful life gives you, in this scenario, $10,000 annual depreciation for the building. So far, so good? Questions? Okay. So 10,000 annual depreciation of building needs to be recognized. Here we go. That's the T account, depreciation expense. And in that, you're going to recognize $10,000 a debit, and you're going to put $10,000 in credit here. So now what is the net building at the end of year one? Net building at the end of year one is building 350 minus 10,000 accumulated depreciation gives you net book value of $340,000 net building. How much depreciation expense we recognize for this year? 1,000. How about next year? Next year, you're going to recognize another, 10,000 one more time, and accumulated depreciation goes up. How about next year after that? You're going to record another $10,000 depreciation expense. Your accumulated depreciation goes up again. So after 3 years, what is the net book value of this building? 350 less $30,000 accumulated depreciation. That's 350 minus 30, it's 320. Let's say you sell the building at that point. If you sell it more than 320,000, it will be a gain on sale of asset. If you sell below 320,000, then it will be a loss on sale of asset. Make sense? Okay, so we did that one. Number 2. For 2019, FICO has credit sales of $200,000. Based on past experience, FICO estimates that 3% of credit sales will be uncollectible. At year end, the balance in allowance for doubtful account has $4,000 balance already left. What is the adjusting entry to record 2019 bad debt expense? Okay, we're gonna go with credit sales. Remember credit sales? That is this option. And that option says the balance in allowance doubtful account is not important because you're not gonna focus on the small amount of accounts receivable. You are looking at the big amount of credit sales. Since you are looking at the big amount of credit sales, then your estimation, whatever it is, you just use that to do the journal entry. Don't worry about what is left in the allowance at December 31st. Make sense? So here is the thing. You have $200,000 credit sales, 3% will not be collected, estimated. So 200 times 3% is $6,000, right? That you need to do the journal entry. Are you going to be worried about the $4,000 left in doubtful account? No, because we said we are calculating this based on the big amount of credit sales for the whole year. So you're not going to worry about the whatever is left in the allowance. So we're going to go directly and debit bad debt expense for $6,000 and put another $6,000 in allowance for doubtful account. So now the allowance for doubtful account has the $10,000 balance, $4,000 from before plus $6,000 now. Let me put this in a T account again. Hopefully you did it, but let me show you anyway. So here I have accounts receivable of 200, no, credit sales, sorry, not accounts receivable. I don't know how much is in the accounts receivable. Let's make it, I don't know, let's make it 30,000, just for fun. And since I wrote it. But the credit sales for the whole year, credit sales revenue. The credit sales revenue for the whole year shows $200,000 credit sales revenue in the T account. And we're gonna go with that. We say 200K times 3% is equals $6,000, right? Okay. And allowance for doubtful account, allowance for doubtful account has already $4,000. If it says 4,000 and nothing else, that means it's on the credit side. If that is on the debit side, the problem has to specifically tells you debit side. If it doesn't say anything, that means is on the credit side. So accounts receivable is $30,000. I just made that up. Allowance shows 4,000. So what is the net receivable right now? Net receivable is 30 minus 4, which is what, 26,000. But it's end of the year, so I believe 3% of credit sales that we sold will not be collectible. So 3% of 200K is 6,000. So I'm not gonna be worried about that at all. I'm not gonna consider that in my calculation, and I'm gonna do the journal entry right here using that $6,000 calculation. So I'm gonna put $6,000 in allowance for doubtful account and recognize bad debt expense. So I recognize this expense because I believe it will happen. I'm not saying it happened, but I'm saying it will happen. Because of that, I recognize it, so my financial statements are properly updated with bad debt expense at the end of the year, and also the allowance has enough juice inside so you can write off later on in future. So here is How much allowance do I have now? 10,000. So what is my net accounts receivable? My net accounts receivable is accounts receivable, 30,000, less allowance for doubtful account of 10,000. So my net accounts receivable is $20,000, which goes in the balance sheet. So in the balance sheet, when I show $20,000 accounts receivable, it means it's net accounts receivable. That's what it means. Got it? So anytime you see accounts receivable net, that means 20,000, that's where it's coming from. And in the notes to financial statements, you can figure out, if you read the notes, it says accounts receivable is $30,000, but based on 3% of credit sales estimate, we added another 6,000, and that's why the allowance ends up to be 10,000, and 30 minus 10 is 20,000, which is showing in the balance sheet. So in the notes to financial statement, you will see this detailed information, but in the balance sheet, you see most probably just net accounts receivable. In some cases, you might see the whole thing. You can see accounts receivable less allowance equals net accounts receivable of 20,000. You might see that in the balance sheet completely available. But most of the times it's just saying net accounts receivable. Questions, please.
What kind of businesses generally have one of the allowance balances? Like, is that something like auditors will look for, or no, because it's not important?
Oh, it's very important. Literally, that's the first thing auditor is looking at. Auditor is gonna look at your accounts receivable, is gonna look at your percentage of estimated, how you wanna use, and you have to use, let's say here you are using a percentage of credit sales. So auditor says, okay, in the next year, you're gonna use the same thing, percentage of credit sales. Auditor wants to know what method you are using, because that will be also in your notes to your financial statements that says, we in our company use percentage of credit sales. And for this year, we estimated 3% of credit sales will not be collected. Exactly, it is in the notes in your financial annual report and financial statements. So auditor gonna look at it, your creditor's gonna look at your financial statements, they wanna see what you are using. And auditor will be very picky. Auditor will say, why 3%? Tell me, explain why 3%. Why not 4%? Why not 5%? Why not 2%? Why 3%? And you have to kind of explain to auditor why you believe 3% it's a good number. Make sense? Because by changing this number, you can easily increase or decrease expense, increase or decrease asset, and mess up the whole financial statements easily to your advantage, because you are the manager and you want to get a bonus. So maybe too much expense is not good for you because you're not going to get your bonus. So you might say, the hell with this 3%, right? Let's make it 2%. Let's make it 2% so I can have less expense. And because of less expense, I have more income. And because of more income, I get more bonus payment as a manager. Make sense?
Yeah, thank you.
Questions, please. Okay. So this is a percentage of credit sales. So we look at the credit sales, right? But there is another way, which is percentage of receivable. If you use the same thing here and you want to use percentage of receivable, then this $4,000 will become a very important subject, right? Because you have to consider that number. But because this is a percentage of credit sales, then we are ignoring what is left in the allowance. It's not a big deal because we are looking at the big credit sales for the whole year. That's too big. So a little bit of allowance here, not gonna be an important issue. Okay. Let's go back. At end of 2019, SpendCo has accounts receivable of 70,000. So draw the T account, please, on your paper. 70,000 accounts receivable, of which it estimates 10% will be bad debt. So multiply now on a side of your paper for a math part. Say it's 70,000 times 10%. Allowance for doubtful account has a debit you see here? Very important. It says specifically debit side. Okay, that means last year they didn't estimate enough for bad debt expense, and this year they write off way too many people, and they end up in the debit side of allowance after write-off. That means allowance T account is already in deficit by debit of 4,000. Okay, so put an allowance T account, debit $4,000. So if you are using a paper, let's put this over there. I want you to start learning again how to do this as we speak. I want you to do that. We speak, you translate it into accounting. Okay, so here says, let me read the question again. So the question says, in 2019, SpendCo has accounts receivable of $70,000, which it estimates 10%. Okay, 10% times 70K equals $7,000. Okay, and allowance for doubtful account, which is a contra account to accounts receivable, has a debit balance of 4,000, which is in deficit. What does the debit balance in allowance for doubtful account showing? That means last year they didn't record enough bad debt expense, and therefore now they end up in a deficit situation. Okay, so what's the adjusting entry for right now for the situation? So you need to have how much based on percentage of accounts receivable. Percentage of accounts receivable, we know 10% will not be probably collected, times $70,000 balance, that's $7,000. So I want how much in the allowance? You see that number, 7,000? That's what I want. On which side? On the credit side. Good. Now you have to tell me, how do I get from 4,000 on the debit side to 7,000 on the credit side? So I need 7 here plus to wash that 4,000. So 7 plus 4,000 deficit, that's $11,000 that I need. So here we go. Allowance, I put $11,000 on the credit side, and I recognize bad debt expense of $11,000. So my allowance ends up to be 7,000. That's exactly what I want, which is 10% of accounts receivable. And my bad debt expense is 11,000. Percentage of accounts receivable method. Any question, please? No? We're good? Again, please, every time I read a problem, as you read, you put it in the T account. You read another sentence, put it in the T account. Put everything in the T account as you read. You translate it from English to accounting so you can see picture. Seeing a picture, everyone can understand this. Make sense? Reading English, it's hard to understand. Plus, if it's a paragraph, then you totally lost. But if it's in the picture, you can constantly see the whole picture all the time. So you are never lost. So here is the journal entry. Bad debt expense, $11,000. And allowance for doubtful account or allowance for uncollectible account, it will become $11,000 credit. What is the term for the difference between the closing balances in accounts receivable and allowance for doubtful account? We call it net realizable value of accounts receivable, which is in this case 70 minus 7, it's $63,000 balance. Net realizable value, that goes in the balance sheet. So net accounts receivable in the balance sheet will show how much? $63,000. This is number 4, match the terms in the left-hand column below with the descriptions on the right. So this is just matching. So I'm just gonna leave it here for a second. You can just study it down the road. It's just regular stuff. Okay, I'm gonna move to the next question. Below are PRUCO entries to 2 accounts for the year. So here is, looks like the allowance has a $1,250 balance. They wrote off once, twice, and 3 times write-off, right? And now it says, what do the debits on the allowance account represent? That means write-off. Show the 3 journal entries for each write-off. Okay, so the $200 means a write-off. That means you debit an allowance for $200 and you close the accounts receivable for that specific customer that you believe is bankrupt or whatever, and you're writing it off. That means that accounts receivable will never be collected again, or to some degree never be collected, or at least for now you believe it's not going to be collected. Same thing here, the next write-off, $100 for another client. And then for another client, you write off again $400. So this is the 3. So if you write off, every time you write off, your allowance will keep going down and down. And now we have just $550. So during write-off, you're not going to recognize bad debt expense. You recognize bad debt expense only in December, end of the year, right? But write-off can be anytime, summertime, springtime, fall season, anytime you might have a write-off. So you write off when you believe it needs necessary. PRUCO uses the percentage of credit sales method. Okay, very important, percentage of credit sales. That means the allowance for doubtful account balance is not important. If it estimates that 2% of $250,000 credit sales will not be collected, what adjusting entry PRUCO record to recognize? So 250 times 2%, it's 5,000. And we're gonna just use that 5,000 for our end of the year bad debt expense recognition. And we put $5,000 in the allowance. As you see, we do not care how much allowance balance is. We don't care about that. Why? Because we are using percentage of credit sales. Questions? Okay. Now it says, assume that PRUCO used the percentage of receivable method. If it is estimated that $4,000 of its receivable will not be collected after doing the math part, what adjusting entry does PRUCO record to recognize bad debt expense? Because we want exactly $4,000 in our T account of allowance, because we are using percentage of receivable, we know exactly we need $4,000. So we have already 550 and we need 4,000. So 4,000 minus 550, that's 3,450, and that's what is required. So we recognize bad debt expense for 3,450 and allowance will be credited. So here you see in this B example, because we use percentage of credit sales, our journal entry is $5,000. But if you use the same scenario, but percentage of receivable method, we're gonna consider what's inside already. Inside we have 550 already, so we're gonna add another 3,450 to make it 4,000. Okay, now this is what I added myself here. Assuming the first client, you remember the first client here? That client that we wrote off $200, that client. Assuming the first client with the balance of $200 written off previously went to church and realized that he will not go to heaven because he did not pay off his liability. Okay, so what's gonna do? So he sent a check for $150 to Pruco, only 150, okay? I know he owes 200, but he didn't have 200. But because he was so nervous about not going to heaven, he put some money together, $150, and he sent a check to Pruco and asked for forgiveness. So what's gonna happen? Now Pruco has a check in his hand. The company has the check, $150 check. What do? First, you go and debit accounts receivable for that Mr. Bad customer. Debit $150 to put $150 in his accounts receivable. Then credit allowance for doubtful account for $150. So far, so good. So you reverse the write-off. But you reverse the write-off up to the amount of check that you received. Yes, the write-off was 200, but you just reverse it up to $150 that you received. After write-off is reversed, then you take the check, go to the bank, and deposit the check, so cash is debit, and close the accounts receivable for Mr. Bad customer. So here, with this additional example, I did show you how to write off a portion of, or the whole thing, or a portion of the accounts that has been written off previously. Any question?
Yeah, what happens if somebody overpays?
What do you mean overpays? Overpays for,
Like if they have a bill and they send too much money, how does that work?
Oh, okay. Do you just close the accounts receivable? So you debit cash, and close the accounts receivable. But if they pay, like in this example, you mean?
Yeah, they
Let's say
paid
they
like $250.
$250. Okay, in that case, you put $150. No, because they owe you 200, right? Here the write-off was 200. They send you 250. The question is why they send you 250. Is it just by mistake? Then that's another story. If they paid 250 because of penalty, that's another story. But let's say they made a mistake. They send you 250 and that's a mistake. So we just debit accounts receivable, Mr. Bad, $200. Debit $50 accounts payable dash Mr. Bad, something like that. Or customer overpayment, debit customer over, make a T account. Call it something like customer overpayment. So debit customer overpayment for $50. Debit accounts receivable Mr. Bad for $200. And then put allowance for doubtful account, $150. Let me put it in the T account. So let me put it in the camera so you can see. I have to write it down. That's why I said you have to write it down, right? Remember? So here we go. Here is the allowance, right? And let's say allowance was how much? It was $12.50 and $200 here write off, $100 here write off, $400 here write off, and the balance is $550 right now. And now this customer is sending you a check. So you got a check. So you say, okay, I got a check, but before I deposit the check right now, I'm gonna add to the allowance a $200 for this allowance. So I'm gonna put $200 in this allowance. You see $200 in the allowance. Okay. And that goes back in the allowance, and accounts receivable dash Mr. B goes up $200. So first, I update the accounts receivable to the correct amount because it was zero, right? When you write it off, it is zero. So now I update it. You see, it was zero before. Now I update it by $200, and I put $200 in the allowance. Okay, so far so good. And then we got a check. We got a check of $250, and that's a mistake. So you're gonna say, okay, I'm gonna deposit this check. So cash will be a deposit. This is a debit, this is a credit. Okay. So cash, I'm gonna deposit this check, which is $250. I have no choice. I'm gonna deposit that. And I'm gonna close the accounts receivable. Accounts receivable will be closed. That's this account. But it's not equal, right? My debit is $250 and accounts receivable is $200. So I need something in between of this, which is that box. So I'm gonna put that $50 here, and here I'm gonna put customer over or short, something like that. So normally I might just call it customer over liability, over payments, over or short. It's fine, either way it's fine. So it's $50 right now. So I deposit the check. I make sure the check is cashed. After the check is cashed, then I'm gonna go ahead. This is one journal entry. Then after the check is cleared and I'm good on that, so now I'm gonna write a check and I'm gonna debit customer over short. I'm gonna debit that, and I'm gonna write a check and send it back to the customer. Or this is one way, okay? Or the customer said, I want to repay this write-off because I want to continue my business with you. Then I'm gonna say, okay, no problem. If you like to continue the business with me, then
Professor, could you add it to something like petty cash?
No, I don't want to do petty cash. No, petty
Oh.
cash is something else.
Okay.
Instead of this journal entry, if the customer says, I want to do business with you, I'm sorry that I went bankrupt or whatever, but now I'm out of bankruptcy and I want to continue the business with you, I'm going to send you, a check to make sure that you are not angry with me. So and he sent $250, and I called him. I said, why do you send me $250? He says, oh, honestly, I didn't know. That's okay. Just put it in my account and we will buy things from you later on and we take care of it. So in that case, I'm gonna go ahead and say cash, debit $250. So that's a debit of the check that he sent me. And I'm gonna put in accounts receivable, Mr. Let's say B, accounts receivable dash Mr. B, 250. So in that situation, what's going to happen? So I'm going to update the T account so you can see what's going to happen. Let's just show you a little bit bigger picture like that. So now I'm going to post this to the T account. So cash will be debited 250. So cash goes up. And then accounts receivable will be credited 250, right? And now what would happen? The balance will have accounts receivable dash Mr. B will have a credit balance of 50. What that means in future, if Mr. B buys any type of goods or services from us, he has already $50 on the credit side. That's why if the customer says, what's my balance with you, accounts receivable? Can you verify with me? I say, give me a second. I look at the T account and then I say, oh, you have $50 credit with us. And that's what it is. It is a credit, right? It's on the credit side. So I say, oh, you have $50 credit with us. So if they purchased, let's say, $300 of service or goods or services from us, let's say in future, so let's sell something. So here is sales. Let's put $300 sales. That's a credit. And they owe us right now. So this is going to become debit accounts receivable, right? So if the customer says, okay, how much do I owe you right now? In the invoice, I show sales of $300. I show a $50 credit, and I show in the invoice payable right now is only $250. Why? Because $300 accounts receivable less $50 credit that we have already in the account. So the balance of accounts receivable for this Mr. B is only $250. So due in the invoice says due $250. Make sense? That's normally what we do. Because if someone doesn't want, if it's write-off and they pay us back after write-off, the reason they do it because they want to continue the business. So we put that extra money they send into the credit side of accounts receivable till they order something and then we wash that out.